Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live show as part of Red Cloud's National Mining Week. I'm your host, Mark Bunting. I host the videos at RCTV, Red Cloud TV. Thank you very much for being joining us today. We have an excellent show, great guests lined up, and a real good cross-section of the mining sector. We're going to kick things off with Chad Williams, the founder of Red Cloud Mining Capital. The theme of his comments will be young talent and the struggle to attract it, and what are some of the solutions for the industry. We'll also be talking to Pierre, Gratton, President, CEO at the Mining Association of Canada, and specifically their initiative towards sustainable mining, or TSM. They brought that in about 20 years ago. They were ESG before ESG was a thing. And in fact, TSM towards sustainable mining has been very influential, not just in this country, but around the world, as many other mining associations have adopted their protocols. So we'll be talking about how TSM has evolved and what the future looks like as well, and how influential that program has been. We're also excited to welcome eventually, a little later on, McKenzie Davis, portfolio manager and investment analyst at Sailingstone Capital in the United States. He and his team specialize in natural resource investments, which is somewhat unusual in the United States to do that just specifically. McKenzie says that Sailingstone has a number of investments in Canada. They have for a long time. They think there are some wonderful assets in this country. In fact, McKenzie started his career with Goldman Sachs as an investment analyst, and one of his jobs was to introduce Canadian mining companies to the U.S. debt market. So he's great with the macro. He'll tell you about his approach to investing in terms of identifying the cost curve being so key, and running the final leg of the relay, batting cleanup, as I mix my metaphors today. David Garofalo, a very well-known name in the Canadian mining sector. You likely know him as the former head of Goldcorp, the former head of Hudbay. The last several years, or a few years ago, he founded Gold Royalty. So we'll talk about that company and its evolution, but also gold itself and the fundamental drivers for gold at the moment. So again, thanks for being with us. We have a great show lined up. We're going to bring in Chad Williams to kick things off here. Again, the founder of Red Cloud Mining Capital. Chad, thanks for being with us.
Hey, Mark, it's great. Such a pleasure to have this opportunity. And by the way, I guess to continue your baseball analogy, I'm your leadoff hitter here. So I'll try to get on base for you.
All right, exactly. You'll be our Ricky Henderson. How about that? Sounds good?
There you go. That's a good analogy. I'll take that all day long. Yeah.
All right, beautiful. Now, at a recent Red Cloud conference, Chad, Rob McEwen, again, another very well-known name in the world, legendary Hall of Fame miner, he said that he thinks the sector is in a dire crisis, in part because it is such a struggle with labor, and especially getting young people into the sector. And I'm paraphrasing here, I'm generalizing, but it appears as if a lot of young people who have some talent, they're going in different directions. They perceive the mining sector to be old school and environmentally unfriendly and so on. So do you share that view? Is that the real challenge right now?
Absolutely. Rob is spot on. And it makes sense. If you're a young person, why would you go into mining? I mean, there's crypto, there's technology, AI, there's all kinds of other industries that are much, much more interesting. mining has got to be at the bottom of your list. So it's our job. And by the way, this keeps me awake at night. If there's one thing about mining that really makes me nervous or worried, it's where are we going to get the next generation of people to populate the mining industry? And that's not just at the mines. It's the regulators, it's the people in the financial markets. It's very, very, very low numbers, and so it's a challenge to attract young people to our business, unfortunately.
So you mentioned crypto, technology, investment banking. From your travels and the people that you talk to, and young people that you talk to, is that what they're mentioning? I'd rather go in that direction or this direction instead of mining.
Absolutely, and I'm obviously not a young person anymore, but when I was young, mining was something that wasn't terribly popular, but it was okay. I remember an example, Mark. I was driving my young daughter. She was probably 14, 15, driving her to school many years ago, about a decade ago. And she said, Dad, I'm so embarrassed. You work in the mining industry. It's such a terrible, dirty industry. And, that really, struck home. So I parked the car over and I said, look at that building. The aggregates used to build that building, that comes from mining. The steel in this car, the aluminum in this car. There's a cliche that if you don't grow it, you've got to mine it. And anyway, I can tell you I did not convince her that day, but ironically, over time, she started to embrace mining. And I think that's, if there's one thing that encourages me, is that if we can educate young people and demonstrate to them that it is not a terrible, dirty industry, that there are many opportunities to make a lot of money. I mean, if you work at a mine, you will make more money than just about any other industry. So it's lucrative. But it's a lot of work that we need to do to educate these folks, because everybody needs to eat, everybody needs to pay their mortgage, but we need to demonstrate to younger males and especially females who are underrepresented in our business that it's okay. In fact, it's great to work in mining. And I can tell you that many people, including the people that work at Red, and many people that are in the industry, many people that are in our industry today weren't in mining, but once they get into it and they start to meet the people in the business and start to be attracted by the opportunities, then almost unanimously they fall in love with our industry. So I'm optimistic about that, but that takes education and that takes time.
So with that education component, how is the industry going about educating? Or do they have programs in place? What's needed? And is it we're talking multiple years to get where the industry wants to go in terms of changing the perception?
Yeah, we do a very poor job. I know that some mining companies got together and they paid for programs in high schools and universities to try to counter the. It's very easy to pick on mining. Everybody who is not in mining, they think of mining as a donkey and a pick and shovel, and it's very an old industry. The point being is that the mining companies got together and they put some marketing documents together to illustrate that. By the way, mining uses technology. Mining uses AI. Mining uses electric vehicles and so on and so forth. But it's an uphill battle, unfortunately.
From my perspective, Chad, I've been with Red Cloud for, I guess, going on 2 years now. Not quite that long, but I can go into the newsroom just over here, and often I'll walk in and it's full, and we have a bunch of, I'm not just saying this because I'm here and I work with Red Cloud, but they're young, they're vibrant, they're smart. And so that's the media marketing side. What's Red Cloud's approach across the board in terms of finding young talent? Because I do see a number of young investment bankers that I've met, and they're all impressive, and you seem to be doing the job. So what's the key?
The key is many of the people at Red Cloud, I alluded to this a few moments ago, are not mining people. In other words, they didn't study geology or mining engineering or metallurgy, but they were recruited because they were or are and were talented in their respective industries, and we trained them here. The bottom line is we had no choice because uh, we couldn't go to the mining industry to recruit. The people just aren't there. And by the way, I will add as a small footnote, the copper price just broke $5 a pound. If copper were to double overnight, let's say $10 a pound, because of the lack of people, the supply response would be mute, zero, no more copper production, even if the price of copper were to double because of the lack of people. That's how severe that shortage is. So, fast forward to where we are at Red Cloud, we have extremely talented, dynamic, vibrant, smart people who, when they were 18, probably never thought they were going to work in the mining business or mining finance business that Red Cloud does, and but they're interested in it. They like the people, they like the chase, they like the opportunities, they buy into the fact that we need these metals for our future. We have no choice, really.
Sticking with that copper theme, you probably know McEwen Copper is developing the Los Azules mine in Argentina. I've seen the plans, and they're very modern. They plan to be self-sustaining, small carbon footprint, no tailings. Again, very, very state-of-the-art and modern looking. It's probably not doable across the board in the sector, but is that the kind of model that most companies should adopt? And would that go a long way in attracting young talent too?
I think so. I mean, that's a good goal, and electrification of mining equipment, that's another good goal. There's a lot of things we can do. There's a lot of things that have been done, and mining is in decent shape for sure. And it's not just the environment, right? It's environmental relations. It's good corporate stewardship. Lots of things that can be improved and are being improved, and I'm confident we're going the right way. I will add something that, in my experience, and I've been doing this for a long time, that people generally in mining, and now I'm going to pick a number, let's say 99% of people in mining love the environment, love the earth. Many of them started as geologists, and they like rocks and minerals, and so there's a deep respect for the environment. Now, like any industry, there are some bad actors, and unfortunately, they make the rest of us look bad. But I think that's an important message to leave with our listeners, that most of the people in the mining business care deeply about the environment and the social causes and the communities where they work.
Lastly, Chad, can you summarize your thoughts on how the industry can get better at attracting younger talent?
Well, when I was studying mining engineering a long time ago, I received very substantial grants from the mining companies, and that made a huge difference to me. I think that's important. We need to start young, and I mean in elementary school. And let's invite kids to these mining operations. Let's educate that. I remember as well, I used to go in and teach geology to my daughter's elementary classes, and all of the kids were interested in rocks and minerals. I think it's a human thing that we have an interest. Now, for some reason, we lose that. I didn't, and fortunately, I didn't. I still embrace it, and everybody at Red Cloud is the same way. But unfortunately, many people they lose that love for rocks and minerals, and I think that's a good place to start, to encourage that. And again, grants, and let's demonstrate to folks through ad campaigns. The World Gold Council has some very powerful ads right now with Idris Elba and other notable actors. That's more of what we need to do. We need to improve our reputation, which admittedly is very weak, very poor.
That's a good point. I've seen some of those videos with Idris Elba. They're educational and they're very compelling. Thanks for your time today, Chad, and shedding some light on this issue. And we'll catch you down the road.
My pleasure. Bye for now.
All right. Our thanks to Chad Williams, founder of Red Cloud Mining Capital. We're going to keep it rolling now. We've got Pierre Gratton all set. He's the president and CEO of the Mining Association of Canada. Let's bring him in. Pierre, how are you today? Thanks for joining us.
Hi, great. Thanks. How are you?
Very well, thank you. Now let's talk about Towards Sustainable Mining, TSM, this initiative that the Mining Association of Canada brought in about 20 years ago. And I'd like to say that you guys were ESG, guys and gals, you were ESG before ESG was a thing. It's really evolved over time and it's been influential around the world. So for those who may not be familiar, could you tell us about the Towards Sustainable Mining initiative, what it is and how it works? Just a brief overview.
Yeah, sure. It's a pleasure. Yeah, TSM, or Towards Sustainable Mining, has been around for now 20 years. This is, I think our 20th anniversary was at PDAC when it was first launched in 2004. And it had been in development for some 5 years. And the motivation was really our board of directors feeling that the industry needed to pull up its socks, needed to operate better, be better attuned to sort of evolving societal expectations, particularly in the areas of sort of community relationships, Indigenous relationships, and so on. Also in, managing our key risks like tailings and so on. So it was, that was the impetus. And over time, it's expanded both in terms of the issues that it covers, and also it's expanded around the world, being adopted now by 12 other mining associations in other countries. So what is TSM? TSM is a whole system for managing your social and environmental risks. Like you said, it's ESG before ESG was even a topic. We have in Canada 9 different chapters that address issues like safety and health, tailings management, Indigenous relationships, biodiversity conservation, environmental and social issues that are key to the mining industry success, managing them well. And what happens is every mine site that's a member of MAC every year evaluates their performance against a whole series of performance indicators in these different areas, and they give themselves a rating or a score. And every 3 years, that score is audited, is verified by a third party to confirm its accuracy. And all of these results are published so that the public can see how the mine, a mine they may be interested is performing, and investors can see as well, or customers can see if I'm buying from this particular nickel mine, how responsible are they? You can see the data behind it. It's a program that's also from the outset been overseen by a multi-stakeholder advisory panel. Working with our stakeholder community, our Indigenous peoples across Canada has been a key feature of this program from the outset, and one that is still very alive, very vibrant today.
Pierre, how would you describe the TSM member base and how they do their best and try to achieve best practices in terms of adhering to the protocols?
Yeah, well, TSM, a couple of years after it was first launched, our board decided that it should be a condition of membership. So today, if you're a member of MAC, you're obligated to implement this program and to report annually on your performance. And what's been interesting is, while I think in the early days, particularly since we were, arguably ahead of our time, there was many companies who weren't members who were wondering, well, I don't know if I want to join MAC. What's this? We even in the early days had a couple of companies say, this is too hard, we don't want to do this, and they left MAC. But in the last, I'd say 10 years, our membership has almost doubled. And I would say in large part, that's because more and more companies recognize that this program has value and is expected of investors and expected of customers, but also actually helps companies manage their risks better and makes good business sense. So it's it's grown in application. It is today, with the adoption of TSM by 12 other countries, mining associations in other countries, become the standard that has the largest level of mining sector participation in the world.
Well, that's impressive, to be sure. There are other standards around the world, as you know, from, say, the World Gold Council and others. So how does MAC help companies align themselves, not just with towards sustainable mining, but the other standards? How much assistance do you give them?
Yeah, and that's become an issue. We were the first. I like to remind people, we were the first. Others have since come along, but they're not all the same either. What makes TSM and has made TSM pretty unique is it was, from the very beginning, a site level standard implemented by mine sites and by smelters and refineries, and with some pretty detailed criteria. Some of the other standards, like the one you mentioned, World Gold Council, is principles based. It's higher level. Doesn't have the same level of detail as TSM, but members of the World Gold Council are also obligated to report against their principles. So what MAC has done, because we have members at the World Gold Council and members at ICMM and other places, we've actually been ahead of many in developing ways of aligning different systems and achieving mutual recognition. So we've developed, for example, what we call the TSM supplement, which negotiated and worked out with these other organizations so that if you, for example, achieve a certain level of performance in TSM on biodiversity, that will satisfy the requirements that, say, the World Gold Council might have with respect to biodiversity conservation as well. So you don't have to do it twice. You can do it once and get credit in both places. It's required some analysis, and it's required sitting down with these other organizations to come to an agreement on equivalency, but we've done that hard work. Now, of course, we're embarked on something even bigger, which we're working with the World Gold Council, ICMM, and the Copper Mark to combine our standards and create potentially a new one, a single standard that would replace all four and create a single global standard that all of our respective organizations would then implement. But that's a project that still has a fair bit of work ahead of it.
Oh, that's really interesting. So, not to put you on the spot, but how many years out are we, or are we talking years in terms of having that one standard?
Yeah, we're at least a year and a bit. We are talking, well into now to 2025 before we'll see the launch, and it could take longer. It really depends. It's a pretty heavy lift, and we are doing this the right way. We want to have 2 periods of global public consultation. We'll be putting the draft standard out there for public review. Everyone around the world will be able to review it and provide their feedback and their comments. The first one will be a 2-month, minimum 2-month consultation period, and the second round, when we'll publish a revised draft based on the first, would involve another month of consultation. So doing it the right way means taking the time to do it right. And that's what stretches us sort of well into 2025, if not early 2026.
Pierre, you mentioned that 12 other mining associations around the world have adopted TSM. How influential has the Mining Association of Canada been in helping these other associations and guiding them through implementation, or are they just going it alone?
No, they're not going it alone at all. It all started with Finland, interestingly enough. And I guess, credit goes to Agnico Eagle, which operates in Finland, as well as, of course, in Canada. And the Finnish Mining Association, our counterparts there, were essentially undergoing the same kind of internal review that we undertook in the early 2000s, saying we need to do something here. Support for our sector is declining in the country. How do we respond? And they looked around the world to see if there were other initiatives they could piggyback on. And Agnico said, well, there is this one. We do it in Canada. Why don't you have a look? And so that led to a number of meetings, both in Finland and the Finns coming here. And then we signed an agreement with them. I guess it was 7 or 8 years ago now. And so they were the first to then formally adopt TSM. And as part of that adoption, our commitment to FinMin, which is what MAC is there, FinMin, is to provide training support. We, of course, make all of our performance protocols and criteria and systems, assurance program, all of that's available. And we've supported them over the years in assisting with their implementation. Now FinMin is entirely really on their own. They're implementing it themselves. They don't need any more help. But we still have a network of partners, as we call it. We meet virtually every couple of months, and we meet in person when we can, like during PDAC, to support one another. The different associations are at different stages. So FinMin is now fully up and running. The Philippines is publishing their first data this year. So they're they're quite advanced. Argentina and Brazil are also pretty advanced. But then we have other countries like Guatemala and Mexico, which only started, a year ago, that are, or a year and a bit ago, that are just at the early stages of implementation, and we're still helping them with training. The good news about TSM is it is available, fully available in French, English, and Spanish, and we have the capacity here at MAC to actually train in Spanish because we have Spanish speakers in the office, including myself, who can help others in Latin America with TSM implementation. And actually, it's Latin America where we have the most extensive adoption of TSM, with several countries in the region having adopted it.
Shifting gears slightly here, Pierre, we know there's been an ESG backlash specifically in the United States. Does that have a ripple through effect to MAC and TSM, or not necessarily?
No, I don't think it has an effect. First of all, we never called TSM ESG. Others have now, perhaps since said that it's an ESG program. Whether ESG as becomes a term that people drop and replace with something else, that may be the case, but I don't see the imperative of managing your environmental and social aspects and risks properly and responsibly being something that's suddenly going to go by the wayside. The industry is going to have to continue to do that no matter what we call it. So TSM is a good system. It's thoughtful. It's been developed for the industry. It makes sense to the industry. It helps them be better at what they do. Why wouldn't they continue to do it? It doesn't matter that some may, say it's ESG or not. When we developed it, as you pointed out, ESG didn't exist as a term. We were talking more about sustainability. We talk about responsible mining. Those phrases are not going anywhere. So we'll continue doing what we're doing, and regardless of the label that the investor community may or may not put on it.
Lastly, Pierre, last question for you here in terms of towards sustainable mining. Is the one key evolution, the one key thing on the horizon, this unified standard that you're talking about, and maybe take us into the future a little bit with TSM?
Yeah. So what's interesting is standards have become a bit of a rage in the last few years. I mean, we developed this very independently, and we were the only standard of its kind for many years. Now the space is quite busy, and there's been a pull towards. And what's been interesting in the last few years is how customers have started to pay attention to this, and not just investors. So automobile manufacturers in Europe in particular, BMW, Mercedes, but also in North America, Ford, General Motors, they're under pressure to show their customers that the metals that go into their vehicles, particularly electric vehicles where batteries are using, lots of cobalt, potentially mined from the Democratic Republic of Congo, where there are concerns around human rights and child and forced labor, et cetera, they're under pressure to show that the products they're using have been mined responsibly. So they've been leaning on groups like ours and systems like ours to provide them with that comfort. And they've also been sort of setting new expectations of what they want to see in standards. And that has also helped TSM evolve in the last number of years. So for example, today, it's a pretty basic requirement that as part of the audit process that site visits be mandatory. And they weren't mandatory in TSM in the early days. They were encouraged, but they weren't required. Today, they're mandatory. There's also an expectation that multi-stakeholders, these standards have a strong multi-stakeholder dimension to it, and that the stakeholder community be involved in decision making around standards. Now, we've had an advisory panel for years, but it's been advisory. Formally, though we have always taken the panel's advice extremely seriously, if we hadn't, they wouldn't have stayed at the table for 20 years. But they haven't formally had a decision-making role. And it's the expectation now that standards have that. So both the new standard that we're working on, the unified standard that we're working on, the vision is that it be governed by a multi-stakeholder board that includes the mining sector, but includes others from affected communities, organized labor, the investor community, customers, Indigenous peoples, et cetera. But also in the meantime, TSM is changing, and we're in the process of working with our panel to change their mandate so that they actually become formally a decision-making body as well. And we'll be governing this initiative in the future through two parties, the MAC board and the panel. And we'll both be working collaboratively on the future evolution of TSM. So it's an interesting space, and one that I think demonstrates how much the industry has changed in the last 10, 20 years, how much more comfortable we are with multi-stakeholder processes, how much more transparent we are, and frankly, also how much we've improved as a sector.
Well, it's been quite an initiative and quite a journey. Thanks for shedding some light today, Pierre, and joining us. We'll see you again.
All right. Thank you very much. Nice talking.
Pierre Gratton, President and CEO of the Mining Association of Canada. We are going to move into the investment side of mining now and talk to Mackenzie Davis. He's Managing Director, Investment Analyst, and Portfolio Manager at Sailingstone Capital Partners out of the United States. Let's bring him in here. Mackenzie Davis, how are you, sir? Thanks for joining us.
Hey, Mark, how are you? Thanks for having me.
I'm great, and we're happy to talk to you. As you know, I saw you interviewed by Keith McCullough over at Hedgeye. It was a very compelling conversation, and I figured we have to get you on. So thanks so much for doing this. Now, it's interesting that you started your career, as you've said, at Goldman Sachs as an investment analyst based in New York. Part of your job was to introduce Canadian mining companies to the U.S. debt market. So I'm curious how that experience shaped your view of Canadian mining to begin with, but also the credit side of the business and how that's approached and how important it is.
Yeah, I mean, I think to be fair, most of my job was getting people coffee and changing colors and presentations late at night. But it was a wonderful learning process. I think the credit side, by definition, you're focused on risks, right? It's a liability that companies need to repay. And so you're not trying to figure out where commodity prices might go over short periods of time. You're really trying to understand what the cash flow and, most importantly, the free cash flow profile of a set of assets are, how durable they are across different commodity cycles, depending on the length of the note or the debt instrument that's being issued. So I think it was really important, to sort of center your focus around thinking through very specifically what the risks are in the natural resource space, mining, energy, forest products. It's all very similar. So that asset quality becomes really, really important. The competitive moat around the asset becomes critical to understand, since everybody is a price taker. Management teams and the quality of management, the way management thinks about deploying capital into projects is obviously critical. And then obviously not as much of an issue in Canada, but for companies that had assets around the world, really trying to understand and make sure investors understood any concerns around what we sort of loosely refer to as above ground risks, but that's title, security, precedent of rule of law. There's a long litany of risks that go in there. So I think that credit background was a really wonderful way to start the investment, my investment education in the natural resource space. And of course, in Canada, there are so many terrific companies that we had the opportunity to work with. So it was a wonderful opportunity.
Now, you've said that in your experience, you find Canadian management teams at mining companies to be quite returns focused compared to some, and fairly prudent when it comes to leverage. Can you elaborate on that?
Yeah, I mean, I think not even constrained to mining, but really across the resource space, we've been fortunate to partner with a number of different management teams with assets in Canada that are operating out of Canada. I think one of the important differentiators between maybe the Canadian and the U.S. market is just capital availability. The debt markets aren't as developed in Canada. There are large pools of U.S.-based capital that can't invest in the United States. And so in a capital-intensive industry, capital discipline, whether enforced or learned, is a really, really important ingredient to long-term value creation. So I think to some extent, it's a function of capital availability, and of course, to a certain extent, it's the inherent discipline of management teams who have lived through cycles, who have seen what happens when you have a depleting asset matched up with a fixed liability, and how difficult that can be. A combination, I think, of lessons learned and maybe some enforced capital discipline just as a function of capital availability.
Now, you've said that Sailingstone Capital has been investing in Canada for a long time and that there are some wonderful assets here. I know that you can't give us any specific names, but can you send us in the right direction? Give us a sense of the types of assets, the types of companies that appeal to you and your team.
Yeah, so we're maybe a little bit different, certainly in the public equity market than some. We have fairly long investment timeframes. We don't think we can forecast changes in commodity price, and so we're really obsessed with those three pools of risk that I just mentioned. And the first is asset quality. So we're trying to find assets that sit at the bottom of a steeply sloped supply cost curve. And so as you look around the world, we don't have a country mandate. We can invest wherever we want. Canada is blessed. If you think about the Montney in natural gas, the Western Canadian Sedimentary Basin, a few years ago, maybe I'm dating myself, was a structurally advantaged asset. Obviously in uranium, you have the Athabasca Basin, same thing from a potash perspective. So that I think across that sort of commodity complex, there are a number of assets, significant assets, globally significant assets that sit at the bottom of cost curves that are pretty steep. And that's exactly our starting point when we think about making investments.
Right. Let's continue that theme of the cost curve. Broadly, Mackenzie, you've argued that the cost of supply of commodities has been going up generally for about 20 years now, since the early 2000s, and that the next 10 to 15 years look pretty good, fairly appealing in terms of investments, but that one has to be tactical. You have to look at certain time windows and also obviously be in the right assets. But again, back to the cost curve, you said you and your team, you think in terms of that at all times. Can you, I like the copper analogy. You don't have to use that necessarily, but could you sort of drill down on that approach?
Sure. So the first, we think about cost curves all the time. It's where we start. And I was just this morning doing a little work around Bitcoin cost curves because they exist. But the reason that we're so obsessed with starting with cost curves is that, again, by definition, in a commodity or a commoditized industry, everybody is a price taker. And so if you have a relatively steeply sloped supply cost curve, you have high cost assets that will come in and out of the market to balance supply. So instead of trying to make a bet on where we think commodity prices might go over short periods of time, which is by definition impossible to forecast, at least consistently, Instead, we can find businesses that have a durable competitive advantage. Usually it's a function of geology. And it's been our experience that those assets earn above cost of capital returns at all points in the cycle, provided that they're not overcapitalized or mismanaged by the management team. And so as we think about investing in the resource space, being long resources, by definition, we're long price risk. And the best way from a business perspective to manage that is by owning these structurally low cost, typically relatively long duration assets that sit at the bottom of a steep cost curve, because that's what protects us from commodity price volatility, not from a valuation perspective, but from a business perspective. So that's why we start with cost curves. The other thing that cost curves do is help us understand what a reasonable long-term price that we can underwrite might be. And the reason the cost curves help inform that is that what we've seen really with most commodities, prices, lots of volatility over the short term, they tend to mean revert to the marginal cost of supply or to some sort of mid-cycle price. And it's typically the price that brings in the next unit of production, since most commodities are dealing with depletion. So even if demand isn't growing, there's a self-reinforcing dynamic that forces prices back to the marginal cost of supply. And so understanding the shape of the cost curve, demand volatility, substitution risks, depletion rates, and things like that can help you figure out what long-term price you're willing to underwrite. It doesn't do you any good to be pro-cyclical in this space. You need to be buying when everybody's selling and selling when everybody's buying. And the only way you can really do that is if you understand the assets that you want to own and you understand the prices that you're willing to underwrite. And then as we think, longer term and looking back, 20 something years ago, that's when we really first started to see the marginal cost of supply for many commodities start to go up. And it was a function of being in a period not unlike the period that we're in today, where capital availability was pretty limited. There wasn't a lot of reinvestment going back into new sources of supply. We heard earlier the conversation around some labor shortages and some of the structural issues facing the industry, not dissimilar to where we were 20 something years ago. All of that was occurring right in front of a fairly significant uptick in demand. I think the situation is very similar today for many commodities. And again, without having to be accurate in our demand forecasts, what we can understand simply by looking at cost curves and the assets and the marginal assets that are producing, we can go back to copper. You can see that structurally prices are rising over time because grades are falling, because ore hardness is going up, not down, because open pit depths are going down, not up. You're investing in water infrastructure, desal infrastructure, et cetera, et cetera. And so there's structural upward pressure in the case of copper on cash costs and capital intensity. And that has to manifest itself in higher long-term copper prices over time. So that's why the cost curve is so foundational for anything we do in any commodity.
All right, great stuff. And I'm sure our viewers may want to go back to the replay of this show and hear that answer again. That was really multifaceted and very interesting. Now, you sort of hinted at your view that post 2011 and then the more than decade plus after that, where commodities in the mining sector really struggled and is maybe coming out of it now, but that led to a lack of capital, a lack of knowledge, a lack of experienced developers, and you talked about the lack of labor, which, as you said, we talked about earlier in the show. So how does that affect and impact your ability to find good investments?
Yeah, I mean, I think the reality, we've gotten used to commodities being readily available. And we've had conversations with different mining executives who are going in and having conversations with auto executives, and so trying to help them get their head around the fact that, when you want fill in the blank commodity, it's not as simple as showing up to the LME. That there may be resource constraints that we're facing, and that really hasn't been the case for the last 15 or 20 years. And so I think the reality is that in many commodities we are resource constrained. In many commodities we haven't had a lot of great exploration success. Those realities have been masked by a period of easy capital, not just low interest rates, but the fact that across many different industries, investors, both on the public side and the private side, were pumping hundreds of billions of dollars into industries and telling management teams who are incentivized to grow, not to create value, but to grow, to grow. And so if you give a capital intensive industry free access to capital, not surprisingly, the capital is spent. The returns were horrible. Hundreds of billions of dollars were destroyed and investors went elsewhere. There are some other issues related to ESG and some considerations around divestment, which we think are largely misplaced, but realities nonetheless, policy decisions have been made. And so the industry really has been starved for capital and forced to live within their own cash flows. And when that happens, it's harder to grow. It's harder to generate economic returns. It's harder to generate discretionary free cash flow that can go back into exploration budgets. And so again, I would draw the analogies to the late 90s and early 2000s. We're at this period of time where a cyclical downturn from a capital availability standpoint is running headlong into some of these structural issues. And as we look out, not sort of ubiquitously, but for many different commodities, I would argue that for the first time in a while, commodity prices are more of a tailwind than a headwind. And of course, from an investment perspective, it makes it a lot easier to put capital to work when you're operating with tailwinds. But it doesn't change the fact that for most commodities where the cost curve is steep, by definition, there are very few what we refer to as structurally advantaged assets that sit in the bottom quartile-ish of a cost curve, run by management teams who are absolutely obsessed with generating economic returns, not on growing. Two totally different things. They're completely unrelated. And in jurisdictions where we can feel comfortable deploying capital over a 5 to 10 year window. So the same things that are driving those commodity tailwinds, I think, call for maybe a more concentrated portfolio, a lot more active management, and a lot more time in the field. There's no way you can understand these assets sitting in an office, and I'm in Houston right now, Toronto, Vancouver, wherever. You have to get out in the field and you have to see the assets and do the work.
You've got to stand on the edge of that open pit mine, as you said before, if that's possible. Now, back to the cost curve, specifically with uranium, and speaking of tailwinds, that sector, of course, has a lot of them. We've had uranium CEOs tell us these are the best fundamentals they've seen in their 30-plus year career. Do you share that enthusiasm, or is it still kind of tricky to find the right assets?
I think that the structural outlook for uranium, I would agree, is as good as we've seen in years. The realization that uranium and nuclear power has to be a critical part of the path towards whether it's net zero or not, but certainly reducing the carbon emission profile of the power sector and to a certain extent the industrial sector, maybe in 5 or 10 years. No question that that's the case. No question that it's an industry that has been oversupplied. Prices were depressed both cyclically and structurally for a period of time, a lack of capital availability and really long lead times, right? You're not popping up a uranium mine overnight. There's a lot of work on the mining side from a permitting standpoint, and then of course you have to figure out how to process the material as well. And so I think as we look at the structural backdrop of uranium, it looks terrific. The cost curve is reasonably steep. There are some really low cost assets that are in safer jurisdictions that are extremely well managed, that make for interesting investments, really good businesses. I think the question today is uranium has gone through the mean reversion that I talked about earlier and starting to get back closer to incentive price. Separating great investments from great businesses. Unequivocally, there are some great businesses in the market. I think each investor now has to start making some decisions around what risks they're willing to underwrite and accept, and what drives those future return streams X price. Because if we know anything, and uranium is a wonderful example, unfortunately, it's really hard to forecast the events that drive price volatility. I haven't yet met anybody who had a tsunami offshore Japan in their supply-demand model. And unequivocally, that is exactly what drove price volatility for an extended period of time. So awesome business fundamentals. I think valuation work, everybody's got to figure out what risks they're willing to take.
That's a good segue to my next question. I've got a couple more here for you, Mackenzie. We've all seen those supply and demand charts for, say, copper and other critical metals that paint a very rosy picture going out 10, 12, 15 years. But is there a risk in just blindly believing that that's going to be the case and sort of believing in those narratives and not questioning those assumptions?
Yeah, it's a really good question, especially today, because I think we've started to see some of that mean reversion in a variety of different commodities. It's really hard to forecast demand. I mean, we always joke internally that every time we try to do it, the only thing we know for sure is that we're wrong. We just sometimes aren't exactly sure why. And so when you start to hear the narratives around, pick whatever narrative you want, but the energy transition, electric vehicles that are the death of oil and the birth of lithium, whatever it is, they're often predicated on some pretty fancy demand forecasts. And that always makes us leery. We want that demand growth to come for free, effectively. We don't like to underwrite what we think commodity prices might be in the future driven by demand, because again, we don't know what demand is going to look like. The other challenge, I think, is around the cycle of different commodities. And so, for shorter cycle commodities like lithium, I think we saw it last year, lots and lots and lots of really constructive dialogues coming from all sorts of different sources around the future of EVs. People got really, really bullish. Lithium prices, went up. And then, of course, demand didn't materialize exactly the way we wanted it to. Supply chains started to build up, and lithium prices came plummeting down, and along with it, the equities. Same thing is true in nickel, which was a big area of concern. I would argue it probably still should be for companies and investors in the West. But today, the nickel market is fairly well supplied out of Indonesia, and most of that Indonesian supply is controlled by the Chinese. And so the supply response to high prices, depending on the cyclical nature of the different commodities, can be pretty meaningful in a very short period of time. So we think the demand for lots of different commodities looks pretty good. We would argue that, yes, there's substitution risk, and for many of those commodities, we actually need substitution to come through. We need technological innovation. It's going to be really difficult to balance supply demand if anything like those future demand forecasts come true, given how difficult it is and how long it takes to bring incremental supply into the market. One of your former speakers was talking about copper prices could go from 5 to 10, and you wouldn't see the supply response. And again, we joke internally, like copper could be 3 and copper could be 10, and not much is going to happen over the short term, fundamentally from a supply perspective, because there isn't a lot of incremental supply to come in. Maybe we'd start to see some demand destruction. So we need to beware of narratives in both directions. When the market gets bullish, you hear all sorts of people forecasting prices, which may or may not come true, but I would argue needs to be a free option. And oftentimes those are the same commentators at cyclical troughs who are telling you that prices will never recover. And we know that's not true as well. And so I think having a really disciplined, quantifiable framework that you can deploy at any point in the cycle and invest countercyclically, both buying and selling, is a critical part of surviving, which sometimes is all you're really trying to do in such a deeply cyclical and capital-intensive industry.
Mackenzie, that was very, very insightful for us today. We really appreciate your time, and we hope to talk to you again.
Great. Thanks, Mark. I appreciate the opportunity.
All right. McKenzie Davis, he's with Sailingstone Capital. Our thanks to him. Now, as mentioned, our heavy hitter, our player batting cleanup, we've got David Garofalo on the line. He's going to join us now, CEO and president of Gold Royalty. David, come on in. How are you, sir? Thanks for joining us.
I'm well. Thanks, Mark. Thanks for having me on.
Now, let's talk about gold broadly off the top. As we sit here, it's sitting near all-time highs, as we know. We also know there are a number of different drivers for the price, such as the U.S. debt burden, negative real interest rates, central bank buying, et cetera. Could you encapsulate your views on the current case for gold right now?
Well, actually, I could probably extend that out 50 years. It's been a one-way trade over that 50-year period. So if you go back to when the U.S. government abandoned the gold standard in the early 1970s, gold was $35 an ounce. Today, it's $2,400. And certainly there's been a lot of volatility between then and now. But we've seen the U.S. dollar lose 96% of its purchasing power over that time. And that's not a phenomenon that's unique to the U.S. dollar. It's one that's quite common across all fiat currencies globally. There's obviously infinite amount of paper that can be introduced in the system, and it has been almost infinite. It's certainly been exponential, where there's a finite amount of gold. But you're right, real interest rates are, I think, in negative territory currently, and necessarily so, because debt burdens are so large and so unsustainable that the Federal Reserve has no choice but to lower interest rates even before inflation is dealt with.
What about that U.S. debt burden, which stands roughly at 34 trillion and rising? How will that continue to manifest itself in relation to gold, do you think?
Well, U.S. debt service over the last 18 months has doubled to $1 trillion a year. And as Treasury yields reset, even with interest rates coming down, Treasury yields will reset over the course of the next 18 months, and we'll see a doubling in U.S. debt service again. So that's $2 trillion of debt service, 2 out of every $7 of tax revenue generated in the U.S. That's not sustainable. It dwarfs what they're paying in social programs. And again, that's not unique to the U.S. We're experiencing a similar phenomenon with debt service here in Canada. And so what that means is real interest rates will likely go deeper and deeper into negative territory. And that will drive capital into gold, because gold at the end of the day is really not a commodity. It certainly trades like one, but it really is driven more by the fundamentals of a currency as opposed to demand supply fundamentals. And currencies trade relative to each other based on relative interest rates. Gold yields zero. Gold is a sovereign instrument, yields zero, whereas other sovereign debt yields negative on a real basis. And that's what's driving capital into gold relative to fiat currencies. That's why China has become a consumer of gold only at the central bank level, but also at the individual level as well.
Now, continuing with that theme, David, do you find it interesting that gold lately anyway has actually been rising alongside the US dollar, alongside bond yields, which is sort of somewhat counterintuitive, or at least counter to the traditional way that it's moved? Is that fair to say that?
Well, bond yields are actually, in my estimation, are going down on a real basis. Certainly on a nominal basis, they've been going up, but I think inflation is far worse than what's reported in headline CPI numbers, because they tend to exclude all the things that we actually spend money on, like food, fuel, and shelter. When you factor that in, inflation on the ground, and we were all experiencing this, is 15 to 20%. That means real interest rates are going down. So what gold is an agnostic barometer of what's happening for real inflation, what's happening to the purchasing power of fiat currencies, because after all, it trades relative to these fiat currencies, but it's at all-time highs in every major Western world currency. And that's because of those economic fundamentals.
Now, we've seen gold stocks get a bid here the last several months, and you can go back to 2016 if you want, but lately they've been doing well, even the juniors. Would you say that we're starting to see some generalist investor money come in, or we haven't hit that stage yet?
I don't think so. and I think that we're still seeing a fairly significant divergence between equity performance and the performance of the underlying commodity. It's been very selective in terms of what has been performing. It's been generally the larger cap players. Juniors are still having a tough time raising money, and I would say it's been essentially a nuclear winter for a dozen years for the juniors, other than the occasional 1 or 2 month window when the market opens up for some of those names. And I think the fundamental issue with producers is the fact that the industry is shrinking. Reserves are in the ground are down 40% from their peak in 2012. And so as a result, we're seeing the big industry players effectively cannibalize themselves. And that's, at the end of the day, a zero-sum game. It doesn't create value in the ground because there hasn't been reinvestment back in exploration because of the aforementioned lack of access to capital for the juniors. They're the ones that do all the heavy lifting for exploration on the grassroots side. And they just haven't had consistent budgets and consistent access to capital to reverse the downward trajectory in reserves. That's why Barrick and Newmont and I hate to pick on them, but I'd say they're the bellwethers in the industry. They're at the same production level they were back in the mid-1990s, and their share prices are below where they were in the mid-1990s because all they've been able to do is increase their share count, not increase their production or reserve levels.
I want to get to Gold Royalty in just a moment and as to why you started it and what's going on with that company right now. But you said that mergers and acquisitions in the gold sector picked up around 2018. Here we are 6 years later. Do you foresee more and bigger deals to come, or has that sort of run its course for now?
I don't see a reversal of that trend anytime soon, simply because the industry is not building anything. There aren't any major capital commitments that are being made in terms of replacing production. So if you're not able to do that as an industry, you don't have a license to do that. And certainly with the lack of generalist interest in the space, I think the big players are going to be quite tentative about committing capital to new greenfield projects to replace depleting reserves. All they can do is feed on themselves, cannibalize themselves in order to sustain what I would argue is unsustainably high production levels, particularly among the seniors in the space.
Now, you said you started Gold Royalty along with your team, in part because, as you've said, gold reserves peaked around 2012. The majors were cannibalizing themselves, and also that you can sort of insulate yourself from inflation with this kind of a structure. Can you elaborate on that strategy?
Yeah, look, I don't want to be building or operating mines in this environment. And the reason I say that is because of the overhang of cost inflation, which unfortunately mining companies and producers are not immune from, but also the downward decline in reserves, the lack of pipeline projects to build. And you wouldn't want to be building them in this kind of inflationary and upwardly dynamic cost environment that we find ourselves in. But I do believe in gold as an asset class for all of the reasons I mentioned before. I think these unsustainably high debt levels, declining real interest rates will drive more and more capital into gold. So it's a great asset class to be in. The best model to be in to get optimum and unmitigated leverage to the gold price is in a royalty vehicle. And the best place to get diversification is in a royalty vehicle. There's no limit to the amount we can diversify our portfolio. We have over 240 royalties in our portfolio. And with the same 8 employees, I could own 2,400 royalties. I could own 24,000 royalties. It's not that much more labor intensive. It's managing contracts at the end of the day. And so really it provides a scalable vehicle that provides optimum leverage to the gold price while protecting shareholders from inflation, but also gives us leverage to exploration because we have over 80 operating partners that own those 240 plus royalties. And each and every year, they invest about $200 million in exploration on these underlying assets. And we get the benefit of that exploration upside without actually having to pay for it.
David, how would you describe Gold Royalty's deal flow right now? You mentioned that junior companies are still struggling for cash. So are they still starving for cash? Is the situation getting any better?
I don't see any sign of that yet. I think eventually there will be a catalyst that sparks capital coming back into the space, and in particular, smaller end of the food chain, where we necessarily need them to be successful from an exploration standpoint to replenish the reserves of the seniors, but also to provide us opportunities to invest in. And so the lack of access to capital for juniors has presented us with a significant pipeline of opportunities to look at. And we've been as busy as we've ever been. In fact, since our IPO in March of 2021, so just a little over 3 years ago, we've looked at over 300 opportunities, and we've invested in 9, including the 3 M&A deals we did in 2021. So for us, we're in a perpetual state of due diligence. It's really trying to find the best opportunities for us to invest in, the one that gives us the best rates of return, solid geological models, good management teams with great track records, and good jurisdictions.
Right. And in terms of finding assets, you said that we're not trying to compete with the Francos of the world or the Wheaton Precious. We can't go there. But what you can do is have an experienced team and stake claims in and around, or not in, but around existing mines. And and then wait for a knock on the door, basically. So could you flesh out that strategy?
Yeah, that's one of 4 platforms we have for growth, where we have an organic royalty generator model where we stake exploration claims in Nevada and Quebec and Ontario around existing mines, existing deposits. And the great thing about deposits, they don't understand man-made boundaries. So as these operators start to drill out their deposits and they trend into our properties, we then farm the properties out and take royalties back in return, and option payments and work commitments. And that's been a very fruitful source of royalty generation for us. In fact, over 60 of our 240 plus royalties have come through that organic royalty generated model, which just requires a sweat equity. And in fact, it's become a profit center for us because we get option payments on those properties when we farm them out, in addition to royalties. But we don't just focus on that. We grow through multiple means. When we had the currency post our IPO, we were quite aggressive in rolling up our peers, and we bought 3 companies over the course of 2021 to vastly expand our royalty portfolio. And we've also grown through project financing and third-party royalty acquisition. And I would say that we're the only royalty company in the space, even among the larger caps, to grow through all 4 of those platforms.
Right. So let's get to some of those deals since we last spoke. You've got the royalty on a Capstone mine, 22 additional royalties in Quebec. You struck a more than $30 million deal with Aura Minerals. Speaking of project financing, a company we're familiar with here at Red Cloud. So can you detail the growth trajectory that you're expecting for Gold Royalty throughout the decade? I remember you said essentially you're looking to 10x revenue over that time, correct?
Yeah, we're looking at 60% compound annual growth in revenue right through the end of the decade, from 6 producing mines and 14 in various stages of development, including the assets that you mentioned. And the great thing about our royalties is they're completely bought and paid for. So we're effectively in harvest mode right now. That growth is embedded already within our portfolio. This year alone, we're seeing a doubling in our revenue. And it's a pivotal year for us because we're transitioning to positive free cash flow and positive earnings over the course of 2024.
Lastly, David, final thoughts on gold itself and how Gold Royalty fits into that landscape.
Well, look, I think we're in a sustained period of increasing gold prices because of all the factors I mentioned: declining real interest rates, increasing fundamental demand as a result of those relative interest rates coming down negatively, and gold yielding zero, but effectively driving capital into gold. And also, I think given the lack of access to capital for the developers, explorers, the emerging producers like Aura that you just mentioned earlier on, we provide a source of capital to meaningfully develop their assets and potential within their own pipelines.
Thanks for your time today, David. I'd call that a grand slam as we continue with the baseball theme. We'll see you again. We appreciate it.
All right. Thanks very much, Mark.
All right. Great stuff. David Garofalo, he is the chairman of Gold Royalty. Our thanks to him and all of our other guests. And thank you very much for joining us today. We hope you learned a lot. If you want to see a replay, we'll have that up on Red Cloud's YouTube channel in no time, and on redcloudfs.com on the website. And you want to do yourself a favor as well. Go over to redcloudresearch.com. All sorts of complimentary research there about sectors, about specific companies. It's definitely worth your while. Thanks again for watching. I'm Mark Bunting. We'll see you next time.